Oil prices continue to fall. Oil prices fell for the fifth day on Wednesday to the lowest since February 2021 after the new reciprocal tariffs took effect, including that 104% duty on Chinese goods and, of course, that return one of 84% on American goods into China. Brent futures were quoting around $60.70 on Wednesday and had lost a fair bit. Brent has stumbled over 5 sessions since those sweeping tariffs were announced. One analyst told Reuters that the White House wants to drive oil prices closer to $50 as the administration believes that the US oil and gas industry can survive a period of disruption. Another analyst said that China's aggressive retaliation diminishes the chances of a quick deal between the world's two largest economies, triggering mounting fears of economic recession around the globe. China's 50 to 100,000 barrels per day of oil demand growth is at risk if the trade war continues. However, a stronger stimulus to boost domestic consumption could mitigate those losses, according to an analyst who spoke to Reuters. Now, speaking of that $50 a barrel oil, which is also a Goldman Sachs extreme prediction, which forecasted that Brent could edge down to $62 by December 25, that's this year, and to $55 to $51 per barrel by December 26. Now, we're already close to $60 a barrel. I reached out to Paul Hickin, chief economist and editor-in-chief at the London-based trade journal Petroleum Economist, and I began by asking him about Goldman's extreme projection of $50 and what it could potentially mean for demand and supply and his overall outlook.
Obviously, that's an extreme case. What's happening right now is that sentiment is running away from reality. What's happening is you're pricing in risk. The market, the hive mind of the market is pricing in risk. We saw that back when the Russia crisis happened about 3 years ago. And although it's the other side of the ledger, the prices started running up to $130 a barrel. It's when the reality started kicking in and people understood what was the actual reality of the situation, then prices started coming back down. And we're in a situation now where there's a lot of brinkmanship, a lot of retaliation between China and the US. That's hurting sentiment, that's hurting stocks. And everyone is looking at how much that's going to affect global economy, recession risk. We're talking about stagflation. And that also feeds into the oil demand situation. And at the moment, demand projections are still holding up relatively well, but the market is certainly factoring that that's not going to be the case further out. And when you be careful of catching falling knives, and that's why you've got this Goldman Sachs prediction of $40 as an extreme case. But I think what we're really looking at, remember, we're still in the 60s. We're still in a situation where it's pretty much not necessarily a sweet spot, but still fairly okay for producers and consumers. It's when it starts dropping below that $60 a barrel, and certainly there's a big threat of that happening quite quickly, that starts to really bite oil producers. But then on the flip side, it's obviously better for consumers. And that's what Donald Trump has been talking about in terms of inflation. That's going to bring down inflation. Plus, obviously the recession, the negative side of that is economic weakness was also bring down inflation. So, yeah, a lot of moving parts.
So we're looking at two kinds of things. So one is, of course, demand slowing down, and the other is supply. And OPEC has already said that it's going to increase supply. Now, between the two, what is playing a bigger role in the way people are perceiving the likely trajectory of oil prices?
Yeah, so realistically, this is all demand driven right now, I would say. I think the OPEC situation has certainly exacerbated the situation, but I think it's more complicated for OPEC Plus. Remember, you've got to understand maybe why OPEC Plus may be doing this, and partly it's to do with bringing in from certain core members of OPEC Plus to bring others into line. The compliance within the group to the deal has been patchy at best, poor for some, and certainly the fact that Saudi Arabia has had to carry a lot of the burden has probably weighed on their shoulders a lot, and trying to get the poor compliers back into line. So then in some ways it could be, if you get better compliance to the deal, then maybe OPEC Plus will be in a better position to provide a floor once this turbulence dies down. I mean, at the moment, it's very little OPEC Plus can do, even if they were to bring extra. Well, they could in an extreme situation. They did it before during COVID, how much they brought off the market, but I don't think they're in the position to do that again this time. And I think it's a case of letting this whole drama play out, which is pretty much on a very much demand side led. And we don't know what whether any deals will ultimately be struck here. And then you've got the backdrop of all this, which what happens when you have prices at a certain level, and if they settle down at a certain lower price, whether that starts to choke off supply, especially non-OPEC supply, which was the big threat for OPEC in the first place. People talk about US or Brazil, Canada, and that will start to dry up quite quickly if prices continue to fall.
So what's the point at which people, let's say, rein in production or cut back on production or even start idling wells and so on? I mean, at least recent history, what does that tell us?
Yeah, so that's everyone has their own break evens here, but what we'd say is that the national oil companies like the OPEC producers, they can produce at very low cost. That's not a concern for them. There are more issues around balancing their budgets and their fiscal demands, which to Saudi it's up at $90 a barrel. For some others in the Middle East it's lower. But at the same time, that's not that's more of a long-term concern. You can balance budgets anyway over a few years by other means. So it's not necessarily completely guiding force for them. And then you've got the sort of the key producers like the US, which is around $45, $50 a barrel, which is where break-evens start happening. But you would probably start getting quite close to that, where fiscal discipline is still a very important part of the US production profile, because most of them now are owned by oil majors, and returns for shareholders are key. So they could start quickly shutting in if prices, and even in this environment where there's a lot of economic uncertainty, a lot of price volatility, that makes all businesses, and especially oil businesses, very reluctant to do as much business. So there's a lot of wait and watch, both from an industry perspective and a market player perspective.
If you were to look ahead in the next few months, so while, of course, we've got this big tariff question weighing on the global economy, and there are trade wars which have started off, what are the other factors that are playing on the oil market and potentially oil prices, which we need to be looking out for, or at least keep them on our dashboard, so to speak?
Yeah, it's a great question, because the fog of tariffs and the trade war it seems to dominate every inch of column inch and every podcast, every media hit. But you're right, there are a lot of moving parts of this. You've got potentially other threats like sanctions on Iran, which could take potentially 1 million barrels a day off the market. Yes, with sanctions, there are workarounds for sure, but at the same time, that's certainly a factor in the market as well. Also, the fact is, lower prices themselves have their own impact. What's the cure for low oil prices? Low oil prices. So while it might not be in the interim, that period, you still got to look out that, like we were just saying, lower prices down to $50 a barrel, 55, starts to really choke off supply at that point. And that's the other side of the ledger when we talk about when the market looks at. Because remember, we've got a lot of sentiment, a lot of risk in the market, but what is core plays out in the market over time is fundamental, supply versus demand. And demand at the moment is the one where we're going, well, let's revise our demand forecast that back. How much we're actually going to be buying up oil. But then you look at the other side of, where's the supply growth going to come from? And when you start seeing potential for non-OPEC supply being choked off, that leaves OPEC Plus with a hand to be dealt and a hand to be played. And while it's certainly bringing back barrels now, 2, 3 months, 6 months down the line, it can look very different. And when this trade spat settles down, hopefully, and when prices settle down, OPEC Plus will have decisions to make, and will have choice about where it can influence prices and provide a new level of stability.
Right. Paul, pleasure speaking to you. Thank you so much for joining me.
Thanks very much.